So, how do you put a price tag on a brilliant idea? A company with a killer team, but no customers, no revenue, not even a single sale to its name. It's a huge challenge. Well, today we're going to unpack a simple yet really powerful framework that's designed for exactly this situation, the Berkus Method. First things first, we've got to understand the problem we're trying to solve. Why do all the usual financial tools just completely fall apart when you're looking at a brand new company? This is what we call the valuation trap. And really, it all boils down to this one fundamental question. This is the one that keeps founders up at night and makes early stage investors just scratch their heads. If there are no sales, no profits, what on earth are you supposed to be measuring? So you might think, what about the classic approach, the one they teach you in business school, discounted cash flow, or DCF? The idea seems simple enough. You just project all the money a company is going to make in the future, and then you do some math to figure out its value today. Sounds logical, right? Well, no. For an early stage company, DCF completely collapses. Without any real data, your projections are just pure guesswork. It becomes what the source material calls an illusion of precision. Basically, a fancy spreadsheet that's built on nothing but hopes and dreams. Okay, so DCF is out. Plan B. What if we just look at similar companies that are already out there and see what they're worth? This is the whole idea behind using comparable multiples. But again, we hit a brick wall. A multiple of what exactly? A multiple of zero revenue is, well, it's still zero. This method is totally meaningless at this stage. It's clear we need a completely different way to think about value. And this is where the Berkus method just changes the whole game. It's more than just some formula. It's a fundamental shift in philosophy. It's all about moving away from trying to predict the future and instead focusing on assessing the progress that's been made today. Now, this quote right here is the core principle. It's so important. Value isn't about the money a startup might make someday. It's about the hurdles, the big, scary risks that it has already cleared. Every major uncertainty it removes adds tangible, measurable value to the company. And this slide just illustrates that aha moment perfectly. We stop asking a fortune teller's question, what will this company earn? And we start asking an engineer's question, what risk has been eliminated? We're not guessing about the future. We are auditing the present. And let me tell you, that shift in perspective is everything. Okay, so how do we actually measure this elimination of risk? Well, the Berkus method breaks it all down into 5 key building blocks. You can think of these as the 5 biggest reasons early-stage companies fail. So by tackling them one by one, a startup actually builds its value. First up, this sound idea. Now, this isn't just about having a cool concept. It's about reducing market risk. Is the startup solving a real painful problem for a very clear group of people? Because if it's not, honestly, nothing else really matters. Next is the prototype, or what you'll hear called the minimum viable product. This piece tackles technology risk. It's the proof that the solution isn't just a fantasy on a PowerPoint slide. It can actually be built. This is what moves a venture from being aspirational to being executable. Third, and this is a huge one for any early investor, the quality team. This is all about reducing execution risk. Does this team have the right skills, the right experience, and just the sheer grit to navigate the chaotic journey of a startup? At this stage, you're betting on the people more than anything else. Next on the list, we have strategic relationships. This element addresses the go-to-market risk. Has the startup managed to get things like letters of intent or pilot agreements or key partnerships? This is that early proof that they can actually find and reach their customers. And finally, product rollout or some kind of early traction. This is the ultimate test because it reduces adoption risk. Are real people, even if it's a tiny number, actually using the product? This is what shifts the critical question from, will anyone ever use this, to, how can we get more people to use this? Okay, so we have our 5 building blocks. That's great. But how do we turn these qualitative ideas into a cold, hard valuation number? All right, let's get into the mechanics of how it's done. Here's the really clever part. The method assigns a maximum value, or a cap, to each of those 5 risk categories. So in this example, you can see a cap of 2 crores per category, which gives us a total possible valuation of 10 crores. Now, this is a crucial design choice. It forces discipline and prevents one area, like a superstar team, from completely overshadowing the fact that, say, they don't even have a prototype yet. The process itself is just beautifully simple. First, You and the investor agree on the maximum caps. Second, you go through each category and assess the progress, assigning a value up to that cap. And third, you just add them up. That's it. Simple as that. Let's walk through a real example from our source material to see how this works. Take a look at the prototype/MVP line. The assessment is that a functional MVP exists. It's not perfect, but it works. So it's assigned a value of 1.8 crows out of a possible 2. Pretty good. Now look down at product rollout. No active users. And the value assigned? A big fat 0. See? The method is really honest about what hasn't been achieved yet. So when we add up all the values from that example, the 1.2 plus 1.8 plus 1.5 plus 0.8 plus 0, we get to a pre-money valuation of 5.3 crores. And it is so important to remember what this number actually means. It is not a prediction of future billions. It's a structured, logical statement about how much risk has been successfully eliminated to date. Now, it's absolutely critical to understand that the Berkus method is a specific tool for a specific job. It has some really clear strengths, but it also has intentional limitations. So let's take a look at the rulebook. So why would you use this? Well, for one, it's exceptionally vast. It also uses founder-friendly language, which can turn what might be a tense negotiation into a productive conversation about progress. And most importantly, it aligns perfectly with how early-stage investors actually think, which is all about risk. And it gives you a defensible starting point for any discussion. But what about its weaknesses? The source material frames these not as flaws, but as deliberate design choices. Yes, the value caps are a bit arbitrary. And yes, it does ignore an investor's specific goals, like their ownership targets. And it is just a static snapshot in time. But these aren't oversights. They are simplifications that make the model robust and useful when you have very little information to go on. And that really brings us to the end. The Berkus method forces us to ground our valuation in reality. It's a disciplined way to have an honest conversation about what a startup has truly accomplished. So, it leaves us with a really powerful question to think about, whether you're a founder or an investor. What is the most valuable risk your venture has eliminated so far?